Evening. Hello, everyone. Thank you for being with us. Bit of an intro on our guest tonight. I'm not going to go through all his extensive CV, but Jarrod Kerr is the Kiwibank Chief Economist. Got a passion for the environment, financial markets and everything economics. And he's kind of messed around, I suppose, in economics and the finance markets in regards to outside New Zealand, the US, Swiss and Australian, working for, US, Swiss and Australian banks. I would have first seen Jarrod probably going back to 2018, 2019. I think that would be when you did a couple of events with Matt Gilligan and his crew. And I've always been very impressed with, I think Jarrod's got a pretty accurate impression in regards to looking forward at where things are at in the markets. Vividly remember, I think in about 2020, when the Reserve Bank at that stage was talking about taking the official cash rate negative. And I think you might have been one of the first people coming out, kind of starting to say that could have been lunacy, with the fact the property market was pretty clearly out of control at that stage and we didn't need to tip any more fuel on the fire. Now, Jarrod, I believe, also basically publishes on behalf of Kiwibank. Is it First View Weekly? Is that what it's called?
Yes. Yep.
Which is fantastic. I keep a good eye on it. And for those of you who are wanting to understand what to do with interest rates, whether you're going to get back into the property market, all that type of stuff, strongly recommend you have a look at that as well. So thank you for taking your time this evening, Jarrod.
Pleasure. I always enjoy doing these.
So I'm going to probably start, if it's possible, with a bit of a deep dive into interest rates and going back, I suppose, to the May official cash rate, obviously after a pretty crazy 19-month period of 525 basis point increases over that period of time. The RB has basically signaled that it looks like it could be the top of the interest rate cycle. And contrary to other commentators, you've been pretty much saying that that should be it. Can I kind of dig into, I suppose, why your opinions are that should be it?
So there are a few reasons. First of all, monetary policy works with a lag. That's our way of saying you raise rates today, and it takes 12 to 18 months to actually feed through into the economy, because most mortgage holders, 85%. Are on fixed rates, so it takes time for them to roll off onto higher rates. So what we're experiencing, now is the cumulative effect of that, 18 months of rate rises that you mentioned. They started raising rates in October 21, and that they lifted the cash rate quite aggressively over 2022 and continued into this year. So last year I came out saying we need to be wary as to how high we go here. That the impact is being felt, and we started seeing it in our data, our transactional data, credit cards, debit cards. We started seeing it having an impact late last year. So yes, I was vocal and saying, look, we need to be careful from this point on. From 5% to 5.5%, might be a step too far, and I'm standing by that. I think what we've seen over the last 6 months or 9 months really has been quite a shift in consumer spending. So households have really tightened up their budgets already. They've been whacked with a cost of living crisis. So the cost of most goods and services that we consume, that we need, are rising at a much faster clip than wages. So people are being hit there, and they're also being hit with a rampant rise in interest rates, and that has proven to be the case, where retail sales has contracted. The volumes that we're getting are much less than a year ago, about 5% down, whereas the value, what we're having to spend, is 7% up. So there's this massive gap. We're spending more and we're getting less, which is hard for households to stomach. And then you're getting whacked with an interest rate increase as well. And for most people who own their homes, there's that confidence impact of house prices falling. You just don't feel as wealthy, right, when you're reading the headlines that house prices are down 15, 20%, depending on where you are. So I do think the Reserve Bank has done more than enough. The peak in the cash rate is most likely going to be 5.5%. There are some commentators saying it might need to go to 6%. I disagree. I think if anything, the next move is a rate cut, and we're likely to get it as early as February next year. So from today, I expect mortgage rates to creep lower, and then next year I think we might see a sharp decline in mortgage rates as the Reserve Bank starts cutting. So there's a lot that households are facing, and there's a lot that businesses are facing as well. They've got the same pressure on interest rates and their costs, but in my conversations with businesses, and I get to do this quite a lot, it's one of the the fun parts of the role. My conversations with businesses have changed. 9 months ago they were talking about their costs going up, particularly labor, the inability to find workers. That was their number one concern, and their costs. Today, not the case. Actually, their number one concern is revenue. They're worried about what the next 6 to 12 months looks like. They're worried about being able to clear the stock that they have, their order books. Their forward-looking parts of the business are of worry to them, and they're actually talking about right-sizing their business, downsizing their business rather than hiring more people. So that's a big turnaround in 9 months.
Would it be fair to say that you mentioned other commentators are maybe saying that the OCR will go to 6%? Would it be fair to say most of them are focusing on the immigration numbers? Yeah,
absolutely, absolutely right.
And obviously, increased people puts obviously potentially, maybe upward pressure on some goods. But is it having an effect on now starting to kind of push downward pressure on wages? Is that coming through?
Yeah, so that's what we're struggling to figure out. So previous migration booms, particularly the one in 2003, proved to be quite inflationary. The last one was inflationary between that sort of 2014 to 2019, but it didn't show up until quite late. This one, the type of migrants that we're bringing in are more lower skilled, more lower paid, and they're going into the areas that are screaming out for workers. So they will put a downward pressure on wages in those industries, which is good news, right? Because businesses have been screaming out for workers, and they've been having to pay a lot more to get Kiwis to do those jobs, for instance. So there's a disinflationary impact there. But then, of course, you've just got more people in the economy, right? More people equals more demand for everything. It's more demand for housing, which we're starting to see already. More demand for our infrastructure, health, education, all of the above. It puts more demand in the economy, and it's trying to figure out what wins. Is it the disinflationary effect on wages, or is it the inflationary effect of just having more people? And we'll figure that out in time. There are commentators saying it's going to be much more inflationary, whereas the Reserve Bank came out and said, well, actually, we don't think it's going to be as inflationary. So they've come out and said that, and they've said that the bar for another rate rise is very, very high, their words. So we will need to see, some really ugly inflation numbers, some really, outsized gains in certain areas for the Reserve Bank to consider another rate rise. And I just don't think we're going to get there.
So just interested with what you said before in regards to the people coming in being more at the lower paid end of the scale. Are they people who are more coming here for working holiday, who are playing or working maybe in the hospo tourist areas, or are the expat Kiwis coming back, or who's actually coming into the country?
So Kiwis is a net outflow.
Yep.
So we've got Kiwis coming back, obviously, but we've got more Kiwis leaving. So that's a net outflow, which is normal. It's kind of like I think it's sort of minus 23,000 over the year. But obviously that's more than overtaken by people coming in.
Yeah.
The migrants that we're seeing are the usual suspects of what we've seen over the last 15 years, where most of them are coming from India, China, Philippines, South Africa, these places. And they come here, they're generally aged between 20 and 35. That's where, most of the bulk come. And of that age group, you're pretty keen to work. You come into a new country, you're keen to get involved, you're a high participant, and a lot of them take those tourist type roles, which is great because our clients in Queenstown and other areas have been screaming out for these workers for a while.
So one thing I'll just quickly say to anyone who's listening, you'll see the Q&A down the bottom. Just feel free to kind of throw any questions you do have into that, and we'll throw those at Jarrod a little bit later on into the presentation. Something I was actually reading on one of your reports that was of interest as well. We're obviously coming into a pretty interesting time with, lead into the election. Obviously, the budget kind of show that the government's going to continue to run deficits, etc. And got some interesting times kind of coming out of that. One thing I suppose I noticed you mentioned is that it's going to be very hard to really give too much more in regards to interest rate advice, I think, until the August monetary policy statement. And you mentioned, I suppose, three key things that you'll be looking at, I suppose, between now and then: the GDP numbers, the inflation numbers coming out in July, and then I suppose looking at kind of what state the employment, or more pertinently, the unemployment numbers are at in August. And I suppose just drilling into those quickly from your expectations, obviously in regards to the GDP numbers in Q1, that's when we had the floods and everything. Are you expecting those to be pretty negative if those numbers come through, or what are you expecting to see there?
Yeah, so we get manufacturing data out later this week, which will be the last piece of the puzzle. At the moment, the first quarter looks like it's going to be around flat, which is our way of saying we don't know if it's up or down, to be fair. It is a quarter which is impacted by the weather, the cyclone. So that's a negative for GDP. That's a contraction in activity over that weather event. But then immediately afterwards, we started cleaning up and rebuilding, which is a positive for activity. You get a drop in the stock of assets, but you get this ramp up in growth as we try and rebuild. So I think regardless of what the number is, it could be plus 0.5, it could be minus 0.5. I think when we drill beneath the surface and actually look at what households are doing, we will see that consumption, I think, would have been quite weak over the quarter, and that follows a very weak fourth quarter of last year. So we saw a contraction in economic activity of 0.6, which is quite a sharp drop in the last quarter of last year. First quarter of this year, we simply don't know until we see it. But most of us economists are calling for a technical recession starting around the middle of this year, starting about now, and lasting for a few quarters. And even those who are not calling for a recession they should have very ugly growth numbers. So it is an awkward period. It's the way I'm sort of describing it, where households are stretched, businesses are uncertain, and in that environment, the combination of a drop, low consumer confidence and low business confidence, that kills growth really quickly. So, that's the activity stuff, and that has been confirmed with the government's revenue. So if you look at tax receipts, GST is well below expectations, and GST, tax take, that's the tax on goods primarily. So that definitely points to a weak economy, but also the corporate tax that the government's getting is below companies' own estimates. So they're coming in weaker. That's weaker revenue being earned by our SME businesses. So again, that points to softness. That should translate into lower inflation outcomes, and this is why we have inflation dropping quite quickly from 6.7% now. It was 7.3 towards 3%, and potentially below by this time next year.
So in regards to inflation, I think I saw recently on the Ipsos survey that cost of living is by far and away Kiwi's biggest concern at the moment. And for most people listening, they're property investors with fair bit of mortgage debt and wanting to understand what's going to happen with rates, whether it's going up or when it goes down, so they can start figuring out kind of cash flow and stuff like that. Inflation, as you mentioned, came in considerably lower. I think the Reserve Bank was expecting 7.2 in the March quarter, and it came at 6.7. Any idea, I suppose, what the Reserve Bank is expecting for the current quarter and kind of where you think we may end up?
Yeah, so it's interesting, right? So half the inflation that we're experiencing has come from offshore. It's important to sort of to state that. So half of that 7.3 or 6.7 that has come from overseas. Inflation coming from overseas is dropping quite quickly. So
my understanding is things like the oil prices and the wheat in regards to the Ukraine situation all coming back quite quickly. Is that right?
Absolutely. So we've got really high base, of this time last year. The war in Ukraine was kicking off, oil prices spiked, commodity prices, as you say, grains and these things all spiked by the war in Ukraine. We're working off a very high base, and these commodity prices are lower today. And I expect, as what's shown in the futures pricing, that oil prices and these commodity prices will be lower this time next year. So the tradables or the imported inflation is coming down quite quickly, which is good, but that's also a sign that the global economy is slowing, and we're going to see recession in large parts of the world, including the United States, Europe, UK, parts of Asia. Very weak growth, which points to much weaker commodity prices. That half of the story is working, in our favor. The other half, the domestically generated stuff, is more sticky. A lot of it's come out of the housing market recently. It costs so much more to build a house today than it did a year ago and a year before that. And there is a lot of inflation pressure domestically. That's the stuff that the Reserve Bank's tackling, and I think that's the stuff that the Reserve Bank, thinks that they're getting on top of. So yes, the Reserve Bank's forecasts have been rejigged thanks to that lower starting point. They see a very gradual decline in inflation over the year ahead. We see a quicker return of inflation to more stable levels, of that 1% to 3% band that they target.
And unemployment, obviously the Reserve Bank had come out and been pretty blunt that they wanted to create some unemployment to basically slow the wage growth and wage spiral and all that down. With the fact that GDP is basically pulling back so much, if inflation gets into control, do you think we are still going to see the job losses on the back of obviously the interest rate hikes, which has got to start basically having discretionary expenditure and stuff like that?
Yeah, I think so. As I mentioned before, the anecdotes that we're hearing from customers, our business customers are more on the side of reducing staff now rather than accumulating. That's a big shift. That's a softening. We are starting to see tentative signs of softening in the labour market. We have thrown 65,000 net migrants into the market. So there's an increase in supply of labour at the moment, where there's a reduction in demand for labour. So that'll put downward pressure on wages. Will the unemployment rate increase? Every time there's a recession, it does. So we're forecasting a mild recession. So we're expecting a mild increase in the unemployment rate. We see it rising from sort of 3.4% now to about 5.5%, which is a material increase, but it's not getting to the levels that we're concerned about. As a bank, one of the key measures that we forecast is the unemployment rate, because with an increase in unemployment, you get a strong correlation with the increase in defaults, or people unable to pay their mortgage. So if we think unemployment's going to increase, we will put a little bit of money aside, in case of a rising defaults. And as you say, it's a very difficult message for the Reserve Bank to deliver. They're saying, look, we're engineering a recession in order to get inflation down, but it's a Phillips curve at the end of the day. And the Phillips curve was invented by a Kiwi economist a long time ago, and that is the relationship between unemployment and inflation. So as the unemployment rate falls, inflation increases, and vice versa. That relationship's been, a little bit, it's fallen apart a bit over the 1990s and 2000s, but it's strengthening again. So that is basically what the Reserve Bank is doing, is looking at that Phillips curve, saying we do need to see some slack coming back in. We do need to see some job losses, unfortunately, in order to get inflation down.
Okay. And so I suppose for a lot of people, they'll be happy that to an extent, at least they can go, well, interest rates are towards the top. So that kind of makes some, investors start to be able to make decisions on, if they want to go back into the market, they at least know that they're kind of buying it at the top of the interest rate cycle. Other big factor, of course, later this year is going to be the election, and don't want to get into too much, the political side of things, but it seems to be pretty clear that if the parties to the right side get in, there's potentially some things which are going to maybe kind of be pretty positive for the property market. Obviously, if the parties on the left side of the agenda get in, that could have the opposite effect. And so I'm just interested to see, have you done any modelling? Do you have any opinions on the biggest one, I think, for investors, of course, has been the removal of the interest deductibility. Have you got any thoughts on, I suppose, firstly, if that's removed, what that could do to the market from a stimulatory point of view, and also any other slightly distortionary factors? Because I suppose what I look at is, at the moment, there's quite a few developers out there who, because what we saw going back to the start of 21 and the whole way through 21 was a huge amount of people became developers. And now what we're seeing is quite a few developers who are holding on to residual stock because it's not the best market to sell it in. And I'm wondering if suddenly we end up with the interest deductibility rule being pulled off, that might push a lot of investors back into the second-hand market, if you understand what I'm trying to say. Suddenly might make some of those investors, those developers, who are sitting on that stock a little bit wary. Any thoughts around that?
Yeah, so in terms of the impact, we really rely on people like yourself to give us a steer as to how impactful these things are, because a lot of things happened at the same time. You had interest rates being lifted, you had LVR restrictions being lifted, and then you had that removal of interest deductibility. All of those things, caused house prices to decline. By exactly how much each one contributed, no idea, because they all happened at the same time. Yeah. But talking to people like yourself, clearly the allowing people to deduct interest again would be a positive for the property market. One thing I would say that we're getting wrong in the discussion around housing is that we focus a lot on the first home buyer, and fair enough, we need to make housing affordable, and we need to do what we can to get first home buyers in. Completely agree. What's wrong with the housing market? There's an undersupply, massive chronic shortage of housing in this country. Why are the investors the bad ones? Why are they the scapegoats in all of this? If anything, we should be encouraging investors to do more in the market. They're the ones that supply the rental stock, and they're the ones that add to the stock as well. And for me, the cure for the housing market is increased supply. So I think you referred to a bit before, but in 2018, when I first came back to New Zealand, the first thing I did was try and quantify the shortage. And we said there's a shortage of 100,000 homes. Now, you may have heard that somewhere else. They used that number, and they came out and said we need to build 100,000 homes, which exactly what they needed to do. Obviously, the execution was not there. It's hard to do, but that is the cure for the housing market, is an increase in supply. If we had an extra 100,000 homes now, our housing market would be much better balanced, and a much more affordable for first home buyers and investors, and not a lot better. We would not have got the wild swings or as much as we did. So supply, and then let's talk about other stuff.
I suppose leading on off the back of that, a couple of things. Do you have any opinions on National walking out on the bipartisan agreement with Labor in regards to the housing density rules? And I suppose also looking at the numbers at the moment, we're going through a stage with a lot of developers who might have got through to consent level, who, because of obviously falling prices in the property market, increase in construction costs, difficulties getting funding, and a myriad of other reasons, have probably kind of pulled back on supply. And then we've got the aforementioned massive increase in basically people pumping into the country. Do you see that kind of us going back to another cycle that we've been in many times before? We're going to be talking about a housing supply issue yet again.
Yeah, unfortunately. So we've had an interesting few years, right? Between 2013 basically to 2019, we had the largest migration boom in New Zealand's modern history, right? Let's not forget that. Did we build enough homes? Obviously not. So over that period, the supply simply did not even keep up anywhere near demand. We then went through an interesting experiment where we shut the borders and we caused a massive drop in population growth. And we actually saw quite a sharp increase in the supply of homes. So supply was actually outstripping demand during COVID and the few years after. So that was fantastic. We were looking at that $100,000 figure, 100,000 homes, and thinking we're actually eating into this, which is awesome. Now that the borders are back open, and we've had a net increase of 65,000, and we think that'll balloon out to 95 to 100,000 in a year. That's, demand is outstripping supply again, because supply peaked last year, and we're starting to see, as you said, people pulling out of building homes. So at precisely the moment demand is increasing, supply is easing off. So yes, that means we start adding again to the shortage that we have. The way we calculate shortage, it's a bit simple really, but we just look at population growth and the number of people per home. So you add 100,000 people, and let's say there's 2 people per home. It's actually 2.3, but you need that sort of 40, 50,000 homes, and we're not building anything like that, unfortunately. So that is going to get worse, particularly with the migration rebounding and supply coming off, which points to further stress in the market.
And I suppose leading back to what I was saying before with the election and I suppose the differences in policy, commentator Bernard Hickey kind of came out and basically said that he thinks national outcome, and we can see prices rise 10 to 20% purely on the back of those. Now, Bernard doesn't have the greatest track record in predicting house prices. He was the one back around the GFC who said everything was going to come back 30% and kind of got that and prices weren't going to move for about a decade. So he kind of got that a little bit wrong. But I can see to an extent where you've got on one side the removal of the interest deductibility rule, something we notice a lot with what we do, and don't know how much you've heard or seen it at bank level, was the introduction of the triple CFA rule changes.
Yes.
These kind of squeeze credit.
Yeah.
And on the flip side, I kind of go, if we've got a government who keeps those in versus someone who comes back and maybe allows the lending strings to be relaxed a little bit, that's got to have an influence on prices to an extent.
Yeah, definitely. Of all the things I listed before, I forgot to mention the triple CFA, which had a massive impact on banks' willingness or ability in their minds to lend. So yes, that was a big thing. I think the removal of some of these things, or the reintroduction of interest deductibility, would definitely have a positive impact on the housing market. The surge in migration is having a positive impact on the housing market. There are a lot of positives starting to come through. I personally think there will be further tweaks in the LVRs. I think they'll be relaxed even more by the end of this year, and then we've got to contend with, debt to income, ratios coming in as well. So I think it'll be a sort of give with one hand, take with the other along there. The Reserve Bank has said that they're more comfortable with house prices at the moment. They've, after the contraction that we've had, they believe they're at more sustainable levels. So that's good that the central bank said that. They will become, more supportive of the housing market here, which means, no more rate rises and actually rate cuts going into next year. And, I think on the regulatory side, they will at worst be balanced in doing the DTIs and LVRs, or if anything, be net stimulatory with the LVRs as they introduce the DTIs. I know it sounds complicated, but from a bank's perspective, it's kind of they'll give us a greater speed limit. They'll enable us to provide more credit cheaper, going into next year, as they'll be more happy with the housing market being stimulated, not restrained.
Yeah, and I mean, I don't know your opinion. To me, the latest loan to value change, I think moving from 60 to 65% on the investment doesn't move the dial at all, because I think the prices have come back so much that doesn't really do anything for people. I do think the move in the first home buyer market might have a bit of activity there. And again, if they were to move to open out a bit more, maybe towards the end of the year or something, that just provides more liquidity to the market.
Yeah, for me, it was more of a psychological change.
Yeah.
So it like you say, it was just minor tweaks. And from our point of view, a little bit more speed limit. Yeah, we can do just a little bit more. But actually, the Reserve Bank has given us a pretty strong signal in that they're no longer trying to restrain the housing market. Actually, they're on a path to easing, and that didn't get picked up, I don't think, at the time. And I thought it was quite a psychological, change.
It feels to me, going back on the back end of 21, they pretty much said to first home buyers, we don't want you buying, because we're going to make it pretty difficult for you to buy, because there's a pretty good chance you're going to end up maybe in negative equity or that type of situation if you're buying at that stage of the market. So they pretty much shut them out, and they're now kind of going, we're going to start letting you slowly back in. On the DTI side, because I find that interesting to see how it play out, because I don't know how much attention you're paid to that, but my understanding is in other countries like the UK in particular, they might use it, but they don't apply it to investment property. Where here, Adrian Orr's made it pretty clear that you're looking at putting it across the board. And I think that would actually be pretty restrictive on property investors. The people who have managed to buy portfolios. To me, having income restrictions is actually a lot more restrictive than having equity-based restrictions. And so I think kind of something I'm interested to see how that plays out is, again, I suppose looking at the political side of things, going back, I think, to last year, I remember a couple of occasions where Simon Bridges got his hand smacked, where I think the question was basically asked, would you have Adrian Orr? And he basically said no, and then Luxon basically gave him a smack. And David Seymour basically says pretty much want him gone as well. And it seems like, in my memory, the Reserve Bank governor position is probably the most political it's basically been. How does that play out if National WACC win going into next year? Because obviously Robertson's rolled or over for basically another 5 years. Is that going to get messy, I suppose, from a, it's pretty clear that some of the players on the right don't want him there, where I don't think we've had a situation like this with the Reserve Bank governor appointment before.
Yeah, you're right. It has become a little political. I'm not sure how that would play out, because I do think he's in for another 5.
Yeah.
And I think that's it. But I could be wrong. So I'm not sure exactly how that would play out. It could get messy in terms of commentary and that sort of stuff. But the beauty of the Reserve Bank is that it's supposed to be independent.
Yeah. That's
the key thing for all sides to play along with. You must have an independent central bank. That's all there is to it.
Yeah.
That's first and foremost the key thing, and I think that'll win out at the end of the day.
Yeah, I'm just interested to see how it plays out, especially in that debt to income space, because we've got the non-bank market, which, funnily enough, are often funded by the main banks, who are running around at the moment trying to create all types of products to almost get around some of these servicing-based restrictions, looking at the DTI framework probably coming in. I think if my understanding is correct, the banks have about a year to get their systems in place, and it can theoretically be implemented from about March onwards.
I think so. I think we got a 12-month warning from April.
Yeah.
So yeah, we've got to get our systems up and running. We don't know, as you say, exactly how they're going to look. We don't know at what level. They might, try it off quite loose. It's not this time. Let's think about it. This time next year, the housing market, I think, would have recovered quite a lot, and we'll start seeing price increases. But it would not be at concerning levels or anything that I think the Reserve Bank will want to jump all over. Yeah. So yes, it's a new tool, it's a new toy. They'll play with it. They'll bring it in most likely, but I don't think that they will put, very aggressive limits on it to start with. It's probably, in their minds, a tool for the next cycle where house prices are potentially running at unsustainable levels, and that's a 2025-26 story, really.
Is there any chance in 2015 they had different loan to value rules for Auckland and the rest of the country?
Yeah,
and obviously that had some distortionary effects by something. A huge amount of Auckland capital went flying around the rest of the country because they could leverage further and stuff like that.
Yeah.
Obviously on the house to income multipliers, Auckland, I think in particular, but maybe Wellington and Queenstown to an extent, are very, very high, where you've obviously got some other places which would probably fly through most DTI numbers. Is there any chance that they would have different rules from a regional basis, you think, or unlikely?
The theory was pretty clear when they were bringing that in 2015, was it? I can't remember the year. The theory was pretty clear. You do it on one area, and then you see capital flight into other areas, right? So we all said, if you do it on Auckland, it's just going to spray around the country. And when you're talking to Wellingtonians, I guess they just scratched their head and said, well, is that really a bad thing? And they allowed it to happen, and then they brought it on, across the country. So I would say, unlikely that they would do that again. They would probably want to do it, at a national sort of level. But you wouldn't rule anything out, really. We've seen house prices in Wellington and Auckland contract the most, right? So the Auckland does tend to lead the New Zealand housing market. You'll see house prices rising in Auckland or declining in Auckland before that you see that elsewhere.
My understanding is we mimic Sydney a little bit.
Yeah, look, Sydney, Auckland, Vancouver, Toronto, there are Singapore, there are quite a few cities around the world that have mimicked each other, and a lot of it was Chinese buying. Funnily enough, we saw money coming out of China for whatever reason and going into English property rights. English property rights as a law is one of the best around, and it's great to put your wealth knowing that it's yours, right? So you see money coming out of places like China and into markets like Auckland for English property rights, really.
Okay. Now, sorry, one sec. Now, the other thing I was going to quickly ask you was Aussie. You mentioned earlier that we've obviously got a lot of Kiwis leaving the country. I'm presuming a lot are going to Aussie.
Yeah.
And saw that yesterday they increased their cash rate, which was a bit of a surprise, I believe.
Yeah, it was. I think the consensus was for on hold, but then people were saying they might come back later. So again, you sort of say, well, if you're going to hike, you might as well do it now rather than later. So that's the decision that they made. They have been 7-8 months behind the RBNZ, and they, as you say, that they've only lifted 400 basis points compared to our 525. So they haven't done anywhere near as much. They've been a little bit more relaxed on the inflation outlook and a bit more pro-growth than our RBNZ, and it'll be interesting to see who's right in this.
Are they getting the same crazy immigration flows coming into them?
Yeah, they're getting strong. I don't know the numbers off the top of my head, but they're pretty strong for Australian terms.
Okay, so I mean, for quite a while there was a commentary that we were expected to have quite a bit of a brain drain going to Australia, higher incomes, potential kind of better cost of living and that type of stuff. Do you think I mean, that probably always happens. There's a lot of young people who like to jump the ditch no matter what's happening from an economical point of view. Are you still expecting to see quite a bit of that over the next 12, 24 months?
Yeah, so if you try and model, try and forecast, migration, some of the best things to look at are relative labour markets, right? So, how's our unemployment rate compared to theirs, or how's the employment growth and wages growth, compared to us? And, the best example was Australia's mining boom after the GFC. We had this global financial crisis, which cause havoc for everyone, but the Aussies just bounced back really quickly as Asian growth bounced back really quickly, and there was a strong demand for hard commodities, and they had this mother of all mining booms, like the largest they've seen, greater than the gold rushes and that in the 1800s. This massive migration boom, billions and billions of dollars being poured into LNG, iron ore, you name it. They had chronic shortages of workers. Kiwis are bloody good workers. We are hard workers, and we get in there and get stuck in. So they want Kiwis, and they were paying us ridiculous amounts of money to do simple jobs like driving a truck or that sort of stuff. So there was a big brain drain. I think it was sort of 2010 to 12. And so that was a big outflow from here, and you do see these relative changes over time, but normally speaking, there is an outflow into Aussie from New Zealand.
And so I suppose final thing before I'll kind of throw up to some questions coming through from people is, when I was pretty negative last year with just the amount that was going on, it was pretty clear that property prices were dropping, interest rates were hiking, credit had basically been turned off. There was a lot of other negative data coming through. It surprised me how quickly some things have turned around. We went through a period from a business where that kind of October, November, December period was dead, and that's normally our busiest kind of quarter of the year. Again, a very, very quiet start to the year, which is of course on the back of the floods. I think most people around the country, but we definitely felt in the north and didn't have the great start to the year with how kind of poor the weather was. Obviously a bit better in the South Island. But it seems, talking to a lot of people at the moment, that there's suddenly become a bit more of a positive undercurrent. I don't know if you're hearing or seeing that from an activity point of view. The mortgage data we're seeing pretty much right from the start of the year has been consistently the lowest months on record. But from a more of a rhetoric point of view, we're suddenly hearing people kind of lifting in activity. And it seems to me with, I suppose, the things we've kind of mentioned with a little bit of an easing in the credit supply, the interest rates potentially peaking, while it's maybe not great from a social point of view, supply stopping in regards to construction is of course good for the property market. It seems to me that we're relatively close to the bottom. And the other part that surprised me is, I'm sure there's going to be some pain, but it's nothing like the GFC. I saw, I think on realestate.co.nz today, I searched on mortgagee sales. I think there's 29 listings, where I saw an article on interest.co the other day where I think they had about 3,000 mortgagee listings up at one stage. And so, I mean, and everything I'm hearing from banks, finance companies, is that their level of arrears is actually quite low. So, I mean, would you kind of sit there, and I know you can't give financial advice, but would you be kind of fair and trying to pick the tops and bottoms of property markets as a nightmare with the myriad of different things that come in? Do you think it's fair to say we're not far off the bottom?
Yeah. So our modelling, for what it's worth, suggests that we'll have a correction of around 20 to 22%. So we're at 17% now. So we're most of the way through that correction, right? And I'm pretty happy with our numbers. I think we'll see another few months of declines. But the true litmus test for the housing market is going to be spring.
Yeah.
Obviously, that's when activity, normally picks up. I think we are going to see a lift in activity. We're hearing glimpses, of green shoots or people, becoming a little bit more optimistic in the market. But bear in mind, for the last 6 to 9 months, we've been, dealing with customers coming to us saying, geez, I've just rolled off a 2.99 rate and I'm now on 6 point whatever. So we have heard a lot from customers, but we haven't got the defaults. So yes, there's stress out there right now, but they're not unemployed, and people fight tooth and nail to pay off their mortgages, and that's, I think, what we're going through. It's this awkward phase, but I think that come summer we will have seen a turnaround in the housing market, and again, there's a lot of drivers for that. The most important is that interest rates have peaked, so people have got that in their minds. They're not going up anymore, and then actually the discussion that we'll hear more and more, I think, by end of this year, is that interest rates are actually heading south again, and that'll really fuel the market. And then there's that demand supply imbalance that I spoke about before. That is only getting made worse by these high risk, properties in light of climate change. So there's even more shortage, coming through. That'll put a floor under the housing market, and I think, this time next year we'll be talking about, how much is the property market going to increase this year, and we think it'll be sort of a 3 to 5% year in 2024. So not spectacular, but quite a psychological shift from contracting to gaining, right?
Yeah, I think we might also see activity. We've noticed on the affordability side, because interest rates are so high, the bank test rates are really kind of shutting a lot of people out. We're finding even a lot of people we get across the line with mortgages are just scraping through. They're not passing with big surpluses through the bank check calculators. And I think, again, if we start to see those drops, those test rates drop a bit, that's always flooding more activity into the market and stuff like that.
Yeah, so you'd actually need to see, the cash rate being dropped for those test rates to fall. So, that probably is a 2024 story. Yeah, it's a while to go.
So got a few questions here, which I'll throw out to you. And if anyone's got other questions, just throw those in the Q&A box. Got a question here from Clive. Will the Auckland market drop in the near future? Is there a supply and demand problem? What will happen with the interest rates? Well, I think we've probably got through quite a...
Yeah, I think we've done that one quite well.
Yeah. Next one is, what do you think would need to happen for there not to be a net outflow of Kiwis or anyone who's been here a long time? New immigrants are good, though losing existing competent people isn't really. What are your thoughts around that?
Yeah, it is the nature of our economy, really. I remember in the 80s them talking about the brain drain, to Australia, and that beautiful line. I think it was Muldoon. He said, Kiwis leaving for Australia increases the IQ of both countries. That was a classic line. So it's been around for my life. What would happen for there not to be an outflow? Economically speaking, we would simply have to outperform. We would have to have stronger wages growth here, so we'd need more productivity gains in this country. And productivity is kind of like the holy grail for economists. It's something that we all want to see. We kind of know how to get it, but it's very hard to really boost it without significant investment in technology and education and all that sort of stuff. So we really would have to offer, that much more than Australia or the UK. But it's also a cultural thing. When I left university, I was basically told to go overseas. All my mates went overseas. It was just the Kiwi thing to do. It's just a matter of how long are we overseas for? And, most of my mates were sort of 1 to 3 years. I was 16 years. Most of us do do come back, but we do lose talent, to that point. And are we getting like for like in our migration? Probably not perfectly, no.
On that question, and I might get my year wrong, I think it's circa 2017-ish, 16, 17, when New Zealand was getting called the rockstar economy. Did we still, even with that, have a pretty strong net kind of outflow of Kiwis, even through that period?
Yeah.
No, it's basically just part and parcel of being a small country.
It's exactly. Yeah.
Okay.
We did obviously see quite a sharp net inflow just before COVID kicked off, when people kind of realized something was happening. We saw a sharp increase in Kiwis coming home, and then we've seen that turn around again.
Do you think the government is setting the wrong example and do as I say, not as I do, and that government spending increase will outweigh the reduction in private spending and stoke inflation?
Yeah, that's an interesting question, Philip. It's a good one. The budget came out, what was it, 2 or 3 weeks ago. It was a little bit more expansionary than most of us thought. So spending a little bit more now and over the forecast horizon. Yes, it is inflationary when a government spends more than you think. But the Reserve Bank made a good point in that, the government has actually underspent quite a bit. So they're saying they're going to spend $100 and they're struggling to get that $100 out the door. So there is actually a chance that they don't get all that spending done. But yeah, I mean, the fiscal impulse, the demand, that the government is the more that they do, the more inflationary it is. You're absolutely right, and we're just going to have to see. That like all governments, they've committed to what they want to do right here, right now, and then they all promise us that we'll return to surplus and that debt will be reduced, etc.
I mean, I was a bit cynical with the date of the election because it seemed to be timed, I think, just before the September inflation data. I think is the thing. It might be just right around that, which seemed to initially be quite convenient. I mean, are you? It's going to be a close election either way. Obviously, surely the Reserve Bank is going to be keeping an eye for any bribes or anything basically thrown out that could be inflationary. Okay, so can I ask what Jarrod's expectation of the medium and long-term outlook for interest rates may be? Is there any chance this decade will be a repeat of the 70s where rates go down from here for a few years, but then go up again even higher?
Interesting question. There are fears out there that of stagflation or inflation outcomes from now onwards that are simply higher than what we've seen over the last 20 or so years. There's a demographic reason for that, which is quite interesting, and that basically since the that sort of 70s, 80s period, we've had an aging population, and that has put downward pressure on inflation and interest rates for the last 40 years. Now that might start turning the other way. Basically, baby boomers, came through and they're all pretty much retired now. So that demand supply dynamic from the boomers, drove, was one of the reasons why interest rates have been quite low for the last 40 odd years, and actually went negative, which we'd never seen before in our history. And we do have interest rate data going back 10,000 years, believe it or not. We've never seen a negative interest rate before, so that was highly unusual. So yeah, higher inflation from here, I think is probably likely. But don't forget that inflation has surprised us on the downside for a very long time. Now it might surprise us on the upside. What is my medium-term guesstimates? I think we've done enough tightening to get inflation back to where it needs to be. So if we're right and inflation is in that 1 to 3% band next year, then the central bank will normalize policy. Now, what is normal in this new world? We don't quite know, but we know it's a damn sight lower than where we are today. So the cash rate at 5.5 is above neutral, which is seen to be sort of 2 to 3%. So I would argue, normalizing policy would be taking that cash rate back down to at least 3%, maybe lower. And if we need to stimulate, then they obviously have to cut below neutral into stimulatory territory, which we're not calling for yet. So, our sort of 5-year view is that, the cash rate gets down to that sort of 2.5–3% level. That would be a normalization in policy.
Just tacking onto that question, I suppose, from me, my understanding is probably since the GFC, one of the major things that drove interest rates down, of course, and partially created the lack of inflation was technology. And obviously, one of the big things that everyone's looking at the moment is AI and ChatGPT and all this type of stuff. Have you had a bit of a look yourself? Any opinions on that, probably in the mid to longer term point of view? Because to me, a lot of it's going to come down to how it's regulated. But for me, that's got the ability to, I suppose, firstly, make a whole lot of jobs redundant. But it also, I suppose, with the pace it can, do some activities and stuff like that, that could potentially be deflationary, couldn't it?
Yeah, you've asked me a beautiful question that I would spend an hour answering. Trying to answer it in 2 minutes is going to be pretty tough. There's a few things I would say. I've been involved in AI for a while. The previous bank I worked at, sort of between that sort of 2013 and 18 period, they had 7 machines that they were training on bank data and other bits and pieces. And from my point of view, a lot of us, hopefully most of us, AI will be quite an enabler. It will enable us to do stuff, a lot faster, a lot better, and able to do a lot more than we normally would. So there's big productivity gains to be had. It is disinflationary. Definitely, it's a disinflationary force, just as globalization was a disinflationary force, or other technology booms. The .com. We're still benefiting from the .com boom today. So I think deflationary. Will it cause job losses? Of course, it has to. And I can give you one example which will lead to thousands of job losses, and I think will happen very quickly, and that's driverless cars. We don't need that skill. It is not a skill that we need, is driving. So I would say, and I hate to be quite harsh about this, but Uber drivers, taxi drivers, bus drivers, train drivers, pilots, these jobs I would expect in my son's lifetime will just simply not be there anymore. Just as
Elon Musk's already said, people might come along and buy their Tesla, have it drop them off at work, and then put it into the rental pool for the day, and it'll
exactly
around doing, basically making people money and stuff like this.
Exactly. I own a car. I shouldn't. Right. My car, I would say 97% of the time is parked. Right. That there's massive productivity gains just in using that car 24/7. Less cars on the road. Massive benefits from driverless cars. We all know that, and we've been looking at that for a long time. This is not technology which is new to anyone. Then there's the AI. In my career, I've seen lots of things that are similar to AI and the actual use of AI. Deutsche Bank, one of my competitors at the time, they outsourced a lot of economic commentary to students or PhDs in India. So there would be an economic announcement, and they would have a group of people in India that would write it up for them, get it out fast, and it was done. Their economists didn't worry about that lower level data. Right? That is going to be done by AI. Can you replace me as an economist? In theory, of course. Absolutely. There are AI out there now that are using all the data that we've got, and they're forecasting just as we're forecasting. They can also write commentary. it might get to a point where they're even doing some sort of presentations like this. I kind of hope, that this doesn't die, that we do want this face to face, we do want to talk to a human, that sort of stuff. But yeah, in theory, a lot of our jobs can be, fully automated, but I would see it as a machine that actually enables me to do a lot more and a lot more accurately than today, so to speak.
I 100% agree. I mean, I think with what you just said there, I think people are going to always hopefully want human interaction. But on the flip side of that, if you're in a back office role, that's when you potentially got more risk.
Yeah.
Okay. Bank commercial lending for development seems to have tightened up. Is that a true situation? And what is driving it from the bank's perspective? Is that a question for you?
Yeah, I don't have a official answer for that. What I've heard is that the sorts of commercial deals that we've been presented with, a year ago or a year and a half ago would have worked, and we would have funded, straight away. Whereas now, I think the numbers aren't stacking up as well with much higher interest rates and the decline we've seen in the market. So that my response there would be, the I guess willingness to transact, or the ability to transact with the current set of circumstances is we've seen credit growth, for example, in that area very weak.
I'll probably make a couple of quick comments there. Kiwibank itself has probably been, I wouldn't want to use the term aggressive, but they've probably been one of the more active participants in the market, probably since the start of 22, when we obviously saw the market start to get a bit more challenging. A lot of the other banks, it became very, very difficult, or would only start transacting with existing clients. Kiwibank has been trying to grow, I think, across the board. And it's more, I think, a case of just indicative of the market. There's a lot of construction companies which are falling over. Costs have been going up, prices have been coming down. It's not a great market to fund development in. So it's pretty standard at the stage of the property or economic cycle to see basically funders pull back. When will the next upswing be? Are we looking at this year and what percentage? I think basically you mentioned before, this person here is talking about a rental portfolio in Christchurch. I think you were kind of saying the 4 to 5% potentially as a 2024 story. Was that right?
Yeah, Christchurch has been a market that hasn't been, thrown around as much. It didn't get the upside that we saw in, say, Auckland or Wellington, and it's not seen the same declines. Yeah. Christchurch market is a good example of what I'm talking about, in that the demand supply balance in Christchurch is much better than elsewhere. I know there was an earthquake and there was a rebuild, a massive rebuild effort, but the demand supply balance in Christchurch is much better than elsewhere. So you haven't seen the crazy swings. Yeah. It is almost like the pin-up case for making sure we get supply to meet demand.
And my understanding is that we pulled some rules off in Christchurch to allow supply to go on. I just don't understand why we haven't implemented that more around the country. Yeah. What happens if interest rates go up further? So I suppose to expand on that, let's say we have a few basically events. Immigration stays stronger than expected. We have an election which is basically ends up having some bribes and is inflationary. Have you done any modelling? Because obviously you are expecting some pain based on the 525 basis points of OCR increases we've already had. If we end up having to go up much further, I'm presuming that there could be some blood on the tracks.
Yeah. So fast forward 6 months. Sorry, I got it wrong. Net migration caused, more inflation. Businesses and households are spending more, than we thought, and there's simply more inflation in the economy. It's dragged the Reserve Bank back into play. They're not going to go by another 25 basis points. If they've made the decision to hike interest rates, after pausing, it's a 50 basis point move, really. Whether they do it in one go or two goes doesn't matter. They're taking the cash rate to 6%. obviously that leads to higher variable rates, higher shorter term mortgage rates, and the wholesale market would have had to factor in another 50 basis points of hike across the curve. So mortgage rates are higher than they are today. That puts more pressure on the housing market. It puts more pressure on the economy, by design. If they're hiking again, they're trying to drag inflation down. So inflation surprised them, and they're trying to get back on top of things. And to your point before, we haven't seen that rise in unemployment yet, but they'll be trying to make sure that it comes through. So it is a way of them trying to slow things down, and it will hurt the housing market. It will hurt the economy.
Yep. I presume your reference to the property market bottoming out. You're just referring to the resi market, as we're just starting to see some reduction to the commercial industrial sectors as yields are only just starting to rise and have quite a way to go to catch up to the OCR rises. The risk premium has been reduced at present. I presume you're expecting further decreases in property values for these sectors as well?
Yeah, we are. I think that there's quite a rebalancing happening as well in commercial and industrial property. You would have a better handle on it than I. I don't look at it as closely, but yes, that we think that correction's got some more legs.
Yeah, we've very much seen, and this is a across the market story with the banks, is that the interest cover multipliers and stuff the banks use at the moment, and I suppose with how low the yields are, it's very hard unless you're sitting on a heap of cash to be able to kind of go out there and transact at the moment. I believe across the board, the banks are very, very quiet in the commercial lending space. Final question regarding inflation. Oh, we've got one more, sorry. Regarding inflation, how much does fractional reserve banking influence inflation? Wouldn't a change in the fraction have a significant effect?
Yeah, so the Reserve Bank is the bank of banks, and the cash rate is used directly with banks to influence the supply of money, the supply of credit in the system. They have forced us to hold more capital.
Yeah.
And they could change that more if they're going to do anything on capital. It would be adding rather than reducing from here. So to your point, that does have an impact on the creation of credit. Banks create cash, not so much the Reserve Bank. I think you understand this, in that when we offer a mortgage, that comes back as a deposit on the other side, and it's the Reserve Bank's job to make sure that we're not seeing inflation, basically, which is the outcome here. So yeah, the Reserve Bank monitors us from a regulatory perspective, make sure we've got lots of capital, but that cash rate really is the tool to manage the money supply or inflation in the economy.
On what you just said in regards to the capital side of things, my understanding, I'm going back a few years ago, I think they were trying to get the banks to hold enough capital to protect them in a 1 in 200 year event or something. And I suppose if we look at COVID and the floods and stuff, we're having one of these events every 12 months. It's like the kind of same at the moment. But I remember there was, I think it was UBS, I might get this wrong, who was talking about that adding like 0.8% to interest rates, and there was quite a bit of fear mongering going on at the time. That seems to have gone quite quiet. My understanding is that all the banks are well above their capital requirements. It doesn't seem to, I haven't heard anything about that having a massive effect on interest rates. Is that expected to have more influence moving forward?
So yeah, we all sort of started trying to figure out what these new capital requirements were going to cost us. Naturally, holding more capital means more cost, for the bank, right? So we would have to see that passed on to interest rates, right? But they did it at a time when interest rates were going south, and the ability for us to fund ourselves was okay. So we didn't actually see much of an increase in interest rates on on the back of it from memory, and that's going back a while. So yeah.
No, fantastic. Well, I want to say thank you very much, mate. That's been really good. Hopefully that's been handy for everyone who's listening. Gives you a bit of a maybe understanding on where interest rates are at the moment, and they're going to go in the short to medium term, and also potentially gives you a bit of understanding on maybe where we might be looking at with the property market as well. If you are potentially tight on, your cash flow, consider just getting your mortgage reviewed so you can kind of understand exactly where you're at. And on the flip side, if you want to be pre-approved to kind of get in the market, kind of definitely get ready, because there are going to still be some good buys kind of coming around. I just want to say a huge thank you for your time, mate. And thank you to everyone for listening.
Pleasure. Thanks for having me on. And
Thank
thanks
you.
for dialing in, everyone.